Hello friends, in this lecture I'm going to discuss a new topic with you relating to fundamentals of partnership only, and the new topic is guarantee of profit, right? So what is there in this topic? Let's see with an example. There are two partners A and B who are running a business, right? They are sharing profits equally, okay? And in the beginning of the financial year, I'll say on 1/4/15, there is a friend C. There is A's friend C who also wants to join the partnership, right? Okay, A and B decided that C from 1st of April 2015 C will be their partner, and C is given one additional advantage. C is given that whatever happens, you will have a minimum profit of minimum share in profit of 40,000. This is a very good situation for C. If out of the profits of the year the C's share is less than 40,000, even then he will get 40,000. If his share is more than 40,000, he will get more than 40,000. Simple. What they are saying is the C is to be given minimum profits of 40,000. If his share exceeds 40,000, then he will get that exceeded share. If the share is 65,000, he will get 65,000. But if the share is 30,000, he will get 40,000. So it is anyways an advantageous situation for C. What it means? A and B both have guaranteed a minimum profit of 40,000 to C. What they have done is, how it is written, A and B have guaranteed a guaranteed a share of 40,000 in profits, right? Now see, for the year ended 31st March 2016, in which C was also a partner, they earned a profit of 90,000, right? Here for this year, the profit sharing ratio between A, B and C was admitted for equal share, 1:1:1. Now what happens if I talk of P&L appropriation account? Here I have the profits by net profits 90,000. Clear? And this profits, if I distribute among the three partners, A, B and C, how much will be the profits? 90,000 divided into 3, 30,000 each. 30,000, 30,000 and 30,000. Simple. But now the situation here is that C is guaranteed a minimum profit of 40,000. A and B have guaranteed a share of 40,000 in profits to C. Now C is short by 10,000. Add deficiency in profits, that is 10,000. So he will get total 40,000, and this deficiency will be borne by whom? A and B. In which ratio? 1:1, right? So how much will A get? A will not get 30,000. Neither B will get 30,000. A will get 25,000, B will get 25,000. So the total comes to clear. This is a very simple topic, that the firm, both the partners as a partnership firm, have guaranteed a minimum amount of profit to another partner. That means another partner will get at least that amount of profit. If his share of profit is less than that guaranteed amount, he will get the guaranteed amount, right? If his share of profit is more than the guaranteed amount, then he will get his share in profit. Clear? So this was guarantee of profit by the partnership firm. Let us see one practical problem on this. A and B share profits and losses in the ratio of 2:1, and as from 1st April 2015 they admit C, who is to have 1/10 share of profit with a guaranteed minimum of 16,000. Right? A and B both have guaranteed a minimum profit of 16,000. A and B continue to share profits as before. That means in the ratio of 2:1. The profit for the year ended 31st March 2016 amounted to 1 lakh. Right? Prepare profit and loss appropriation account. Now, see, how much is the profit for year? Profit is 1 lakh, right? Profit is 1 lakh, and what is the C's share in the profit? 1/10 share. C's share in profit, this comes to 1/10 of 1 lakh. How much? 10,000. But how much is the amount guaranteed to C? They admit C, who is to have 1/10 share of profit with a guaranteed minimum of 16,000. Now his share is 10,000. So that means amount guaranteed is rupees 16,000. So C will get 10,000 or 16,000. He will get his minimum share of 16,000. Remaining profits, is 1 lakh minus 16,000. That comes to 84,000. Now A and B will get the share out of 84,000, not 1 lakh. A's share is 2/3 of 84,000. This comes to 56,000. And B's share will be 1/3 of 84,000. This comes to 28,000. Clear? First of all, we will pay the partner who has been guaranteed a minimum amount of profit. We pay him 16,000, his minimum guaranteed amount. Then the remaining profits will be distributed among the old partners in old ratio. Now if I talk of profit P&L appropriation account, this becomes very simple. if I say by profits, the total profits were 1 lakh, right? To profits transfer to A 56,000, B 28,000, and C his guaranteed minimum of 16,000, because otherwise his share in the profit was 1/10, 10,000 less than the guaranteed minimum. So this will be your profit and loss appropriation account. So this is a very simple logic. There is a profit of 1 lakh, C's share is 1/10, we'll calculate his share 10,000, but the guaranteed minimum is 16,000, so we will pay him 16,000. What are the remaining profits? 84,000. A and B will distribute this remaining profits in the old ratio, right? You have to do all this in working note. Clear? Till here, B's share. This is all your working note. This is very, very important part of the question. You have to show the workings, then you can prepare the profit and loss appropriation account directly. Clear? You can write this down. Now, this was case 1. Let us see case 2. I'll take a similar example. A, B, 1:1. C is the new partner with minimum guaranteed profit of 40,000. Right? The profits earned were 90,000. Now, earlier what happened? A and B both have guaranteed a minimum profit of 40,000 to C. Now, in this case, what happens is B says to A that C is your friend, you should guarantee him the profit, and I will not guarantee him the profit. Okay, B says, why should I sacrifice my share in favor of C? He is your friend, you can guarantee him minimum profit, you sacrifice your share, I will not. Simple logic. C is A's friend. B says, why should I sacrifice my profit? Okay, you sacrifice your part of profit in favor of your friend C. Now, what will happen? Let's see. If I prepare profit and loss appropriation account, here I will have by net profit 90,000. Clear? To profits transferred to partners capital accounts A, B and C. Now A's share is 30,000, B's share is 30,000 and C's share is 30,000. But C is guaranteed a minimum of 40,000. So he will get deficiency recovered. Now this time he will recover the deficiency not from A and B but from only A. 10,000. So he will get his 40,000. B's share will remain 30,000 only, because B has already said that I will not sacrifice my share, because C is A's friend. So A should sacrifice. Why should I sacrifice? Now A sacrifices 10,000 out of his share minus guaranteed, sorry, I will say deficiency transferred to C 10,000. Now A will get 20,000. Earlier what was happening, A and B both were sacrificing 5,000 each, and they were getting 25,000. Now B says, I will not sacrifice. C is your friend, you sacrifice, you take care of his guaranteed minimum profit, I will take my share, and okay, bye bye. Right? So A says, okay, I'll sacrifice my share, no problem. So this comes to 90,000. This is case 2. So I have discussed two cases with you. One is when the whole firm is sacrificing. All the partners in the firm are equally responsible for guaranteeing a minimum profit to the new partner or another partner. Case 2 is when only one or two partners of the firm, not all the partners of the firm, when only a few partners of the firm are responsible for transferring the deficiency to the partner who has been guaranteed the minimum amount. Clear? Right? Let's see a practical problem on this. X, Y and Z are partners in a firm. Their profit sharing ratio is 5:3:2. However, Z is guaranteed a minimum amount of 10,000 as share of profit every year. Clear? Any deficiency arising on that account shall be met by Y. Why? Because Z is Y's friend and not X friend. Okay? The profits for the 2 years ended 31st March 2015 and 2016 were 40,000 and 60,000 respectively. Prepare the profit and loss appropriation account for the 2 years. Let's do it. It's a very simple problem. First of all, I will say profit and loss appropriation account for year 2015. In the exams you have to prepare the proper accounts. Okay? So I'll say by profit, the profit for the year 2015 is 40,000 and profit sharing ratio between AB and X, Y and Z is 5:3:2. So two profits transferred to X capital account. What is his share of profit? 20,000. Y's capital account comes to 12,000. Right? And Z's capital account 8,000. Now what is the minimum guaranteed amount to Z? Z has been guaranteed a minimum amount of 10,000 and any deficiency will be met by Y. So his share of profit is less than the guaranteed minimum of 10,000. We'll say plus deficiency recovered from Y 2000, so his profit will 10,000. X will not sacrifice any share, so his profit will be 20,000. Now this 2000 deficiency will be borne by Y minus transfer to Z's capital account. How much? 2000. So Y will get only 10,000, right? And Z will get his guaranteed minimum of 10,000 from Y. Deficiency borne by Y. Clear? Is it clear? Now let's see the next part. Profit and loss appropriation account for 2016. Okay, for the year 2016 we have net profits of 60,000, right? Profit sharing ratio is 5:3:2. So two profits transfer to X capital account. How much? 30,000. Y's capital account 18,000 and Z's capital account 12,000. Now Z was guaranteed a minimum of 10,000. Here he is already getting 12,000. He is happy with that. No need to recover deficiency, no need to pay the deficiency to Z. So all will get their share. 30,000 X, 18,000 to Y and 12,000 to Z. No deficiency here. Clear? So in this question both the cases are covered where there is a deficiency to be borne by one partner and when there is no deficiency at all. Okay, all the partners will get their respective shares and be happy, right? So this was another problem on guarantee of profit, right? So you can write this down.